the $5 million. Oh,
Sorry, yeah,
um,
forgot to record.
around the $5 million. But we had to go public companies because it was very difficult to find anything concrete on private ones.
Right. And then how did you get the 4 and 6 for the EBITDA multiple?
The ones that I showed.
Yeah, yeah. Like you got, E4, E14 and E15. How'd you guys land at that?
E14
Hmm.
here.
Yeah,
Or
like EBITDA entry multiple at 4x and
in
EBITDA
the
exit
in
multiple
the
at 6x.
assumptions.
Yeah, so how did you guys come up with that if you weren't able to find much data?
Just something that made
No,
sense.
no. We ended up did finding three companies. It's on the comparable sheet. If you go to the comparable, and then we did the average of the three
Hmm.
using you can go to that sheet, Enrique.
On the comps, right?
You're
Which
saying that?
which sheet?
Yes, the comp sheet, and can
Yeah.
you show that?
Oh, I just showed. Yeah, here. That's what you were saying, like, no?
Did you
I'm
just the comp sheet or
I'm not
tab?
seeing the so there's after the balance sheet, the income statement, there's the comps one, the last one we did.
After
Like, do
which
you do
one?
you wanna do you wanna do do you wanna share your screen?
Yeah.
That's okay. Okay. Let's move a little
Do I
bit
need
more
to
quickly.
end? Do I need to end it, or you do you?
Yeah, yeah. Let's just move it over to Lie real quick.
I gotta stop share.
Yeah, no worries. So Lie, you want to go over the comps? Yeah, there we go. Okay, this is great. And how did you guys come up with these three companies? Lie, you're on mute.
Yeah.
Sorry. I found, or I just Googled first what were public traded companies that were ed tech, and then looking at the revenues, I found these three were like the closest in terms of size. And then looking at the market cap either. LAIX is a bit bigger given the market cap of 85 million, but the other two were fairly similar. And then so our multiples was based between the China liberal education because we felt that one was the most realistic given the EBITDA of the other.
Yeah, so basically, like, if I'm understanding correctly, because the U.S. stock market had enterprise values way too high, you wanted to find companies that had smaller market caps, right? So you looked at to the Chinese stock market to get comparable apples to apples comparison. Is that correct?
Yes, that is ultimately what we end up deciding on.
That's great. That's great. That's really smart. So these types of things, when you're making these keen assumptions, right? Make sure to put it in as a footnote. So normally what I do is I would at the end of that same row just add like footnote number 1, and then it would just be at the bottom. So it'll be another assumptions within that tab. So if your boss or your client or your banker questions you like, wait, where the hell did you come up with these numbers? They just refer to the footnote. Because the like we talked about in the first class, the rationale of the assumption needs to be explained really, really clearly. It's not the numbers that matter. So that's really good. Did anyone else take a similar approach looking at publicly traded companies from foreign markets in order to get the same size?
I wish.
You wish? Like,
did
I wish
not,
I
but
knew I
wish
could
did.
reach.
That was a smart play.
Yeah, that was really smart. So I've done exercises before where we would look at companies from China, Canada, Middle East, because the company sizes are significantly smaller. So it helps if someone speaks a foreign language. I remember I had to go through a sim in like Spanish before, It's like, what the hell's going on? But you know, at the end of the day, if you just find the numbers, it starts to make sense. Yeah, that's really good. Very good, Lai. And then continue. Oh, were you done?
Sorry, is there anything else you wanted to see?
Yeah,
other
yeah,
than-
yeah. And then go back to your presentation. Okay. And then why don't you just go back to the assumptions here? And let's just make sure we covered everything. Okay, so 15, 40, and 5. So what about the gross margin, SG&A, these types of percentages? How did you come up with those assumptions?
That was, we were looking at the financials that you gave us through the PDF, the CIM,
Mhm.
and like for the revenue, I believe they were on, for 2020 and 2016, they were growing at 20% or 22, and so we averaged out to 15, and then we put 40% for the revenue growth because that is a good year, and then I believe they went down -2% as a bad year, so we estimated 5% downside, and then the same with the gross margin. I believe they were profitable around, like it's at 67%, so we give them a base of 65, and we didn't think their profitability would increase that dramatically in a good year. That's why it was 70%, and then 60% if there was any fluctuation. And then for SG&A, there we put 20% because we actually thought their base would be lower given they don't have brick and mortar, is more digital. However, just to be safe, we did increase it by 35% on the downside. And the other we didn't really touch. We did not, it's 1%. For in terms of account receivable, it was on average on the basis of 13 days. However, given the estimate, it could be 10 days or highest at 20 days. It was that was more average. Inventory days, we didn't have inventory, so 0 for all 3. And then other sales, I'm not sure. For accounts payable, since we were one paying, we just put 27 days since that was standard. And then days accrued, 60 days. So that's when we did the whole 90, 30 days just for assumption wise. Risk casing.
Okay, that's great. That's great. And then let's go to the summary. And then afterwards, let's take a look here. Where did you put the EBITDA multiple for the transaction value? So what's the estimated transaction value you guys arrived at? Meaning, what was the assumed acquisition price you thought it was?
I think it was 37 million.
Where is that number?
I think it was. I think it was. Do you remember where it was, Enrique, by chance? I think it was, oh, here, there's total 37 million.
Oh, okay. So you
It was in
guys
thousands, yeah.
played with the cap table. Okay.
Yeah.
And how did you add the EBITDA multiple that you landed at, which was, what was that, 4 to 6x? Did you use that number?
46.
Because then by that logic, you would have landed at like 6 million. So I thought that's where you got the 6. But I was confused if you meant 600,000 or 6 million. So remember you went to the comps, right? Go back to the comps,
Yes.
Lai?
Yeah.
And then you did a great job getting the EBITDA multiple here, right?
Yes.
And I think you did 4 to 6, right?
Yes.
So what you would do is you would apply that 4 to 6 EBITDA multiple, and all you got to do is apply it to the current year's EBITDA number. So that would just give you a valuation about roughly 6 million, I think, because your EBITDA is about 1.5. But then how did you get 37?
I think we're just messing with the cap table, and that's we want to like share what the assumptions were.
Okay. Okay, that's interesting. Yeah, good try. I mean, you guys hit some key ones. The real exercise was the comps, which you guys completely nailed it. That was excellent. That's what you should do. If you can't find comparables in the US, using, you know, foreign companies is a really good way of going around that. Definitely. So good job on that, guys. Um, Anyone else have any other questions about some of the assumptions that Lai and Enrique made and had very different viewpoints on certain things? Okay. Oh yeah. Logan?
I was gonna say, how'd they get the base upside and downside for the SG&A again?
Guessing, just assumption.
Speculating.
Yes.
All right,
yes.
that's cool.
Okay.
Thank you.
Puya, would you I did like your submission. Would you like to volunteer? Would that be okay?
Yeah, sure.
Okay, thank you, sir.
So me and Ahmed present together. Is that right?
Yes.
Okay.
Look at that. It's good comp.
Yeah. So basically, I want to begin with the comparable companies and how we choose them. And we choose companies that operate closely to edtech, artificial intelligence, and application industry. I maybe reviewed like more than 60 companies, US equities, and almost 90% of them had negative EBITDA. So because our valuation was based on enterprise value to EBITDA multiple, we tried to find more. We also
Puya, we didn't hear you for 10 seconds. Can you repeat that? Or like maybe 5 seconds. Did anyone, was it just me that missed Puya or?
No, we
okay.
can hear.
Yeah, so basically, we reviewed more than 60 companies and US equity. We didn't thought about other foreign markets, but more than 90% of them had a negative EBITDA. So because our valuation was based on enterprise value to EBITDA multiple, we tried to find more companies with positive EBITDA. And we found few private equity in same industry which raised funds through investors and VCs, but there were no data about their revenue and their after fund valuation. So we just did our analysis based on these public companies. Ahmed, if you want, you can take it from here.
Yes, sure. And I will talk about how we calculate the average of EBITDA. The average of enterprise value revenue to revenue multiple, as you see here, 16 and 65 for enterprise value to EBITDA. This is mainly because it's technology companies that have lower earnings due to the higher operation cost. Their primary focus on their revenue, and also because our company is not public traded company, so we consider lower EBITDA because of the comparable companies have average of 65, but we use a reduced value of 25. Also, we consider a higher multiple for exit because the size of the company will grow significantly by the exit time. As you can see here, the entry multiple is 25, and we estimate that the exit will be 30.
As you can see, we just allocate hypothetical assumption for sources and uses to just make a potential deal, and like potential buyer would like take the company. And also for growth rates, as you can see, we did these numbers based on the company's forecast. So the base one is based on their forecast for year 2021. We used historical data of their financials and the management view of the business growth rate and company's potential. Our best guess would be case one and base one, I mean, and we get to enterprise value of $37 million at close. Let me go to return analysis here. So as you can see, it should be here. Yeah. So $37 million as close, and for the exit value after 6 years, it would be $194 million. And I believe I have the, yeah, that's it.
Can we go over the SG&A and the
Yeah, sure.
gross margins really quickly? And you don't have to do the accounts receivable, all that stuff. The meat of the assignment is for the gross margin and SG&A, that part.
Yeah, so as you know, they had estimates for year 2021, and they predicted that their gross margin would be 67%. So we just basically put 67% as total, and after that for upside is just a guess based on their financials in years before, 70% and 61% for downside. And for SG&A, the same thing happened. I just calculate, they didn't report like as a percentage. I just calculate their 2021 SG&A. And so it was 26%. And I said, yeah, so maybe 2% for upside and 4% for downside. And yeah, for account receivable, actually I calculate the account receivable too. It was like 17 days, and because their account receivable was like payable, account receivable days was decreasing, you know, year by year. So I thought, yeah, maybe they have the potential to do 10 days too if they are like doing really good job. And same thing for payable, and as you know, they don't have inventory.
That's great. Scroll up a little bit. Okay, and then go to the summary tab. Okay. And then the exit at 15, 6.4 million would give you a valuation of almost 200 million.
Almost
what you
200.
landed at. Okay.
Yeah, because you know there are like tech companies, and tech companies are like focused more on revenue. So if I want to be honest with you, actually I did the EBITDA based on the revenue. So I somehow like entered the revenue multiple that I think they would have, because I saw all tech companies and software developing companies, they more like focus on high growth revenue more than EBITDA. As I told you, 90% of them, maybe more, have negative EBITDA. So yeah, basically I thought about revenue more than EBITDA.
Okay, gotcha. That's great. That's great. Any questions? Yeah, Lai.
Can you go back to your assumption page?
Sure.
Because it shows that if you go all scroll down, I think yours says that you have a negative 1.5% on the revenue growth rate.
Yeah. So I saw your report. Actually, the year 2021 didn't happen actually in the report, I believe. It's just an assumption. Yeah, so maybe you should like put just 2020, and after that for 2021, you can like put it as, um, let, let me show you my, yeah. So this is the data that happened for 2020, and they thought that 2021, they would have a growth rate of 24%. I can,
Interesting. Thank you.
yeah, sure.
Okay. Anything else? Okay. Yeah, so this was really good. I really appreciated the exercise that you guys did with the comps. How many companies did you guys look at, Lai?
Total, we probably looked at six companies total.
Oh, okay. And Puya, you looked at 60 and narrowed it down to something like 10.
Yeah, it was like really hard, you know, to find some companies that they have like positive EBITDA, because negative EBITDA doesn't have a meaning to us, you know. We
Yeah.
just use them.
Okay. So what's let me just ask you guys this. What's another trick to get potentially the same companies, but at a multiple potentially closer, right, to I guess like, a smaller company? For example, like a DocuSign or well, they've been around for a while, like Adobe. Or I mean, DocuSign hasn't been around for a while. Or Akamai Technologies. I think that's been a while for a while as well. What's another trick to find something at a closer to the same size?
Maybe we can look at their past data.
Yep.
So when they were like, but I thought about that, but I think that the technology is different, the economic is different, the expectations are different. But yeah, this is another way.
Yeah, exactly. So Puya is exactly correct. So if you wanted to find data at a smaller size, you could go back, 15 years ago when Adobe was much more smaller. The problem is the environment might be very, very different. So that would be very tricky to do. So let me just share with you guys our spreadsheet, and then we'll talk about what happened to this actual deal. Do you guys want to find out? Okay. What do you guys think our valuation was? Anyone want to take a guess?
100 million.
100 million?
This
Priya,
for
you said 100
CIM?
million? Huh?
For CIM or
For this same company, yeah.
I don't know. Let's throw 8 million in the mix.
8 million? Who said 8?
Me, Logan.
Oh, Logan? Okay. So we got 100 million and then we got 8 million. Anyone else? Try to see where I download.
I thought you mean exit valuation. I believe.
Oh.
Yeah, close valuation. I believe 37 million.
Yo, like what did we offer? Exactly like yours. Okay. I'm pulling it up. Just give me a second. I'm just waiting for the Excel to load. I hate running Microsoft products on a Mac. Just so slow. So fortunately, we had some data. Just premising this, we had some data indicating or showing us what kind of deals are, I guess, happening in the private markets. So we didn't have to do a comparable analysis. So unfortunately, I thought we still did it, and I just noticed it earlier today. We never ran a comparables. But what's interesting about this is that we were able to find certain assumptions, and I'll show you guys those assumptions or some of those transactions in a second, but we came up with a valuation of around 6x of EBITDA. So this gave us a transaction value of about 10 million, 10.2 million. And then if you're a little bit generous, it was a 13.5 million. Now, tech companies in the private market are valued at a ARR multiple. Do you guys remember from last lecture when I talked about the reason why, okay, what's the reason why tech companies are based off of a revenue multiple than an EBITDA multiple? Does anyone remember from last class? Okay, so oftentimes when you develop tech, there's a lot of R&D, right? That happens. So the revenue grows a lot more quickly compared to, you know, the EBITDA margin that catches up. So because of it's very forward-looking, investors are very comfortable with a revenue multiple opposed to an EBITDA multiple. So tech companies, especially in the, you know, in the VC space, they all, like, the reason why they can IPO like that and they have negative EBITDA margins, Puya, with the research that you did, is because the technology hasn't caught up to reflect the EBITDA. So in that case, that is correct. But the problem with this, if you look at this sim, although it is growing quickly, you could see that this is not a high-tech company that, like an ARK-K, that Kathy Woods would invest. Where's the page with the user experience? It's made like in the late 90s or early 2000s. So our argument to the bankers, like, look, this is not a tech company, guys, get out of here. So we gave them a multiple that was more like professional services. So the sellers wanted 20 million, but our bid ultimately landed at about $13.8 million. Now, you know, were we off? Were we not? No, I don't know. We were ultimately 103 finalists. And then we were the one that killed the deal because we didn't think the technology was good enough. Going into the structure right here, we were very, very pessimistic on the downside because we couldn't identify why this product would be very strong versus a, you know, Pipedrive or a Salesforce, etc. So this is basically enrollment, sales and marketing software to enroll students in maybe professional schools and all that stuff. And we just couldn't find anything that could have been that could potentially hedge against you know, some of these bigger companies entering their market. And the upside, we kept it steady at 24%. Because we thought the COVID year bump wasn't really sustainable, and forward looking, we just didn't think, you know, it was going to be that great. Gross margins and SG&A, we didn't tinker around with this. We did like how the company was going more and more towards software, but because a lot of the technology was kind of legacy software oriented. So going back here, if you look at the sim again, looking at the financials, not this one. We did like the, you know, somewhat upward trajectory of, you know, the COGS being stable, not increasing or decreasing, but we're still kind of pessimistic about this company. But we did like the, you know, EBITDA increasing, which still made it, you know, pretty interesting case because it seemed like their operations were becoming a little bit more efficient and they were moving more and more towards software. So that was something that we were kind of debating back and forth. So ultimately we submitted a bid at about $13.8 million. Even though we were the lowest bidder or one of the lower bidders, they really liked the value proposition that we were providing. And then, yeah, we decided to kill the deal before it got too serious because it just wasn't worth pursuing. Ultimately, also for this company, I didn't like the company because they weren't really good at sales, nor were they really good at software. So if you're going to fix a house, you'd rather have one part of the house, maybe like an F, for example, than having like, you know, loose ceiling and like the second floor shaking and like a beaten down garage. You'd rather just like not have a garage and just like, all right, I'm just gonna build this garage from scratch. But if there's like so many different parts you have to fix, it's kind of like fighting two battles to win one war. So ultimately, what killed the deal was the mediocrity, just kind of prevalent throughout all departments. They're just not good at one particular thing, and that's really bothersome to me, which I think also exemplifies the company culture. Any questions about the sim or some assumptions? Maybe looking through the sim.
Do you know their actual revenue at 2021?
So far, they're on pace to hit 5.2 million.
Okay, good.
Yeah, so it's pretty solid, pretty solid. And I think about 2.1 million in EBITDA. So I might be shooting myself in the foot at the end of the year. But also, you have to think about it this way. You're comparing your opportunity to buy this company versus all the other company options that you have. It's not like if this was the best company that we found, or if you're in a PE firm or if you're a VC firm that you're willing to invest and you need to deploy capital, and company X is like the best company that you can find, but you find a company like that's growing 2 times as fast. But for the other VC firm, like, you know, company X is still that best company, like, and you miss out on that deal. So what? Just buy company Y that's growing much more quickly. So for us, is like out of the, you know, maybe 5 to 10 deals that we're getting more serious about, this was like, you know, number 7, 8, 9, or 10. It wasn't that great compared to some of the other ones. There's 2 other companies that's doubling every year, for example. So it's like, why should we spend any more time on this when we're finding other companies that were, you know, doubling every year, and a few that are growing about 50% year over year.
I think they don't spend enough on their R&D and SG&A compared to other companies, 60 companies that I told you. I just look at them. So I thought maybe if they like increase their spending and don't pay any dividends, they can higher growth. I don't know completely about their like potentials. Can they like improve and like add new products, add more like advanced technology? But my evaluation was like based on they can do that. They can like ignore paying dividends and just focus about R&D.
Yeah, I mean, during the year of COVID, they just paid themselves like $1.3 million. It's like, you could take this opportunity and double, triple your growth, right? So it's like, it's concerning when, you know, you're not even making that much money, you know, and 25% goes back to like the management bonuses. Can you imagine that happening for a publicly traded company? 25% goes back to the C-level executives as a bonus. It's egregious, right? There was this other guy, one of the companies that's doubling every year. He makes like 3 million a year last year, and then he paid himself a $500,000 bonus. I'm like, dude, this is ridiculous. Why would you do that? just for himself as the only owner? I'm like, okay, so if we buy you, are you gonna keep paying yourself $500,000 as a bonus? He's like, nah, we're not. I'm like, all right, well, we're gonna get that written, 50K a year for like 3 years until we double. Just kidding. But this is a really good example and very good observation, right? Their R&D is so low, they haven't really invested a lot in the product. And these numbers, right? Priya, wouldn't you agree? It tells a story about the company. You can kind of get a good sense. I mean, you know, numbers could be embellished, fabricated, hidden, and all that stuff, but it gives you an idea just by looking at certain key areas on, you know, how it integrates right into the product and the overall company trajectory. So good pickup right there. Any other thoughts, comments? We good? Okay, sweet. So if you're, you know, still kind of trying to understand this, feel free to book a appointment with me. And then we could go over some high level stuff. But yeah, hopefully you guys had a good time doing this. Okay, so let me just pull up the lecture notes. Okay, so here's just kind of like ours, if you guys want to take a look. And yeah, let's just talk about general fundraising concepts. Okay, so let's say you're starting a company, right? Did everyone get a chance to watch the YouTube video? It's like 10 minutes. It's pretty good. Okay, so let's say you're trying to raise money for a company, and when you're starting to raise, you get your co-founders. There's an incredible amount of startup costs that could potentially be incurred, right? Upwards of tens of $1,000s, hundreds of thousands of dollars. If you're lucky, maybe it's just a few $1,000s, right? So you need to go out and raise capital. And let's say you're going out there to raise capital, you and your buddy, right? Let's say Vince is going to go raise capital, right? With Persia, right? They started a business together, and they're going to need to raise some money. And do you guys remember the 3 F's? Friends, family, and fools, right? So you're going to go ahead and try to raise money from some, friends, family, and fools to cover the initial startup costs, maybe get an office, maybe get a prototype, etc., right? And when you're going to raise capital, you have to divert the cap table. So what is the price of a publicly traded company, right? The market cap, number of shares outstanding multiplied by the share price. So assume each stock is worth $1, each share is worth $1. What is the value of the company in this scenario? So there's 100,000 shares, right? And then each stock is worth $1, and it's split in this way. What's the value of the company? It sounds like a trick question, but it's not a trick question.
100,000.
What's that?
100,000.
Yeah, 100,000, right? Yeah, so it's as simple as that, right? So let's say this person invested $40,000, right? And then each share price was worth $1. He has 40% of the company, of a company that's worth $100,000, right? Same for this person and same for this investor. Pretty simple concept, right? It gets really complicated when we're going to talk about pre-money, post-money, dilution, all that stuff, stock options tomorrow, actually. So just remember this concept, and if you haven't watched the video, make sure you do, because tomorrow we're going to talk about SAFE, convertible notes, or convertible debt, all that stuff. Okay, so when you're starting to raise, right, seed money, and let's say now this same investor, right, raised $20,000 and got 20% of the company, but invested $50,000. Now, what is the value of the company? 20,000 shares, right? Meaning 20%, and now he invested $50,000. What is the company worth now?
$150.
Kuya, what is that?
He invests another 50,000, right?
No, not another. This is completely different. Now he owns 20% of the company when he invested $50,000.
250.
Yep. How'd you get that?
20% is 50 and times 5, 250.
Yeah, very simple, right? So if he put down $50,000 and he has 20%, all you have to do is take 20%, divide that into 50K, or 5 times 50K, and then that gives you a valuation of $250,000. Okay, we're gonna go one step further. let's say this guy is the only investor. Is that pre or post money valuation? Like the total money that, Vince and Persia raised over here, is 250K or 50K from investor Enrique, right? So in that scenario, what is this a pre or post money valuation?
Post money valuation?
Exactly. And then what would the pre money valuation be,
Pre.
Enrique? I think you froze.
$20,000, $200,000. I mean,
200, right,
Yeah.
right. So post money valuation is the pre money valuation plus the investment or total fundraising, and then you get the post money valuation. It's really important to understand that because it is common in Silicon Valley for investors and entrepreneurs to mean two different things. So entrepreneurs, they want to, focus, right, on the pre-money valuation. So after they get the money, it brings them to a higher valuation, while the investors want a post-money valuation, so they get a cheaper amount when they're putting money in. Does that make sense? So when you're raising capital from investors, even if it's not a startup, you have to be very, very clear on if it's pre or post-money valuation. Okay, so this is the concept. So you're taking $50,000 divided by 20% gives you $250,000. Same thing, right? So if the two founders each put down $100,000, they each get 40%. And now the cap table is full. 40% for Vince, 40% for Persia, 20% for Enrique. And now the cap table is complete. Now let's say Vince and Persia, they grow the business significantly, right, over a year, and now they have to raise a much bigger round, right? It could be a larger seed round, or it could be a Series A round, right? $1 million. So they'll be raising from, let's say, angel investors and venture capitalists, and then it's the same concept, right? So VCs. Where does the money from VCs come from? Does anyone remember from the reading? How do VCs raise money?
Wasn't part of it through angel investors?
It could be. It could be angel investors, but normally startups raise money from angel investors, right? So VCs need big. They operate a much bigger fund, right? So it could be banks, institutions, university endowments, just billionaires, like super wealthy individuals, right? So they raise money, the money goes into the VC company, and the venture capitalist has to deploy the capital into that new startup. So we're going to cover this in just a minute, but basically, as I explained earlier, when the money comes in, right, and the money needs to be deployed, it goes through a process, right? There's a pre-money evaluation that the entrepreneurs set. Then the Series A investments comes from usually from multiple investors, VCs, angels, syndicates, etc. Then it becomes a post-money valuation. So sorry, pre-money here, Series A investment, and then a post-money valuation. So this is very important when we're going to talk about term sheets tomorrow. So if you haven't had the chance, just watch the video one more time. Otherwise, it can get really, really confusing. So yep. So same picture. So any questions on pre, post, money invested? We're good? Okay. So before we go into fund structure, can we just take a 4-minute bio break, if that's cool? 6:56. Okay, let's take a quick bio break. Okay. Thanks, guys. And we're back. Cool. So let's talk about fund structure. Does anyone remember how a fund is structured?
Are you talking about equity and debt?
No. Like, so we're putting on our investor hat this time. So we were more talking about, when we're going through the valuation, we had our investor hat on, then we put on our entrepreneur hat on, or how this fundraising works. And now we're back putting in our investor hat on to now think about, okay, so, why do investors invest, and what kind of structure are they operating under? So we're going back more to the investor side again. So how are funds structured? Whether it's a PE fund or a VC fund, it's pretty much the same thing. Real estate fund in the private equity markets. How is a fund structured, generally speaking? Does anyone remember what a managing partner is? What's a managing partner? Okay, does a managing partner run the fund, or is it the LP, limited partner, that runs the fund? Okay, not sure. Okay. Okay,
Oh.
let's just go.
Limited partner?
Limited partner is an investor. So they're passively on the sidelines, hoping that whatever the managing partner picks will make them a lot of money. So this is just kind of a general overview. Make sure to go over chapter 10 if you haven't. So this is VC Fund Management LLC. So there's an associate, which some of you guys aspire to be under a PE fund. Basically the slave, let's just call them, associate, AKA slave. And then there's a vice president, there's the partners, right? Partner normally meaning managing partner. That's what they mean. Someone's going to be a partner in an LLC. It just usually means managing partner. It almost never refers to the limited partner, right? So you have the partners at the top, you have the vice presidents, you have the associates. The partners usually fork in a lot of money to launch their fund. This is really important to understand, because if you understand the culture at the top, like the majority of like post MBAs and the majority of people who come out of really good schools, or the majority of people that get into really good banking jobs, they're really loud and proud of getting into a Goldman Sachs or KKR and stuff like that, right? Bragging to their friends, driving nice cars, 6-figure salary, whoop-de-doo, right? So you made it compared to your peers, right? But once you make it to VP, it's very, very, very hard to break into becoming a partner until you sold your company. Why is that? Anyone want to take a guess? There might be 2 reasons. Why is it hard to be a partner? Like, unlike a law firm, why is it hard to be a partner from a VP once you become a vice president at a PE fund or a VC fund? Line.
Is it because they don't want to lose you as a VP?
No, I could see that. No, they don't want to deal with the power struggle, the insecurities. No. Anyone else want to take a stab?
Is it kind of like just a very different job, kind of? One is more overseeing kind of the, I'm not sure actually.
No, it's really because, first of all, you don't have enough money because you have to buy yourself to being a partner usually. And then secondly, you're not legitimately a partner in a lot of these funds until you sold a company. You're just the numbers guy. So there's a little bit of a class system, which is very ironic because sometimes entrepreneurs are not the ones that get into Goldman Sachs, right? Or the Sequoias of the world, but then they're the ones that start those types of funds after they exit, which is quite fascinating to me. So it is not uncommon, for example, a VP or a rising associate to work for one of the startups he or she invested in, because they want to get an exit and say, I have operating experience. So it's very different when someone who has entrepreneurial experience looks at a startup. They just oftentimes don't look at the numbers, because especially when it comes to tech companies, it's very, very difficult to assess a valuation of a company. And for those types of reasons, VPs will sometimes try to join your company if your company is doing really, really well. So even for Founder Legacy Partners, I had an investor that wanted to join us as a operator, just a month and a half ago. And we got into this huge argument saying like, dude, you're an investor, like chill out. You're supposed to put money down, not work under me. So it is not uncommon for that to happen if your startup's doing really, really well, because they want exits. It's kind of like, if you guys follow sports, those are like championship rings. If you don't have a championship ring, you don't belong in the Hall of Fame. It's kind of like that. So you see the VC fund management here group, and they'll have fund 1, fund 2, fund 3. And then oftentimes, each fund will manage different types of themes, basically. So fund 1 could be like biotech, fund 2 could be like edtech, fund 3 could be like fintech, something like that. Once these funds are doing really, really well, sometimes they don't have like an exit, but they're doing really, really well, they'll raise their second fund, right? And they'll start like branching out into these like pyramids. So they'll have like multiple funds within this huge holding company. Now, what does that mean to you as an entrepreneur, right? So let's say fund 1 raised $100 million and they only have $5 million left. And you are raising, right, for this fund, which is, which one did we say this was? I can't remember. EdTech, let's just say, right? There's $5 million left, right? What can you do with that data? What does that mean to you as an entrepreneur trying to raise money for your EdTech startup? And let's say this fund doesn't exist and these funds are not pertaining to you. There's only 5 million left, and this is the EdTech fund, and you're raising for your EdTech startup.
So there's only $5 million left available for the fund.
That they need to deploy.
Could you just reinvest that back into the fund or something like, or into one of the companies?
No. Okay, let's just okay. So let me just kind of re-explain this. So Logan, right? Let's say you have company, let's just say Logan Tech, right? And what Logan Tech does is that it's basically a new and improved Canvas, right? It's just a Canvas that is kind of like Udemy. It's just next level, right? Students can pick their courses. It's school agnostic. You could take courses from any school or something crazy like that, right? And then it has predictive analytics on how well you're going to do in each class, and what job you should get 10 years later, and whether you're going to succeed or fail in life. It has everything, right? And so it's Logan Tech is like off the chain. It's like the hottest startup. And then let's say hypothetically, Luke, right, is under VC fund management in charge of EdTech. He's invested in everyone, Lai, Vince's startup, Enrique's startup. He only has $5 million left. You're trying to raise, let's say, $10 million for Logan Tech, right? And for example, Luke only has $5 million left, right? What does that mean to you? How does that impact you and your meeting with Luke that's happening, let's say, next week? How would you strategize that if you knew that? Do you think, let's just think about it this way. Would Luke be pickier if he had only 5 million left? Or is he going to be like, man, let's just get rid of the 5 million and just like give it to Logan? Which direction would he go?
Probably pickier.
Why is that, Lai?
because he has a limited amount of resources. So if he's going to invest, he's going to invest in something he believes is going to succeed.
Yeah, exactly. So the less, this is called dry powder, right? In the VC world. Same with private equity world. It's just called dry powder. The money that needs to be deployed with the committed capital that you have for that fund. So fund one, if it was 100 million that they raised, the 100 million, where does it go? Does it sit in a bank, guys? Where does 100 million go? Let's say Luke raised 100 million from Warren Buffett, Elon Musk, Facebook, JP Morgan, Prince of Saudi Arabia, and now there's 100 million for fund one. Where's 100 million? Where does it go?
Doesn't it go to the companies you're investing in? Or that are within the
No,
fund?
but until he decides to invest, where does it sit?
It should be in money market, treasury, something that give you at least like some few interest until you decide when you want to invest it and how to invest it.
Anyone else have another opinion or any thought? Okay, so unlike an asset management firm, that's not how it works. The 100 million is actually called each time Logan makes an investment. So there's a commitment period. It could be 5 years, it could be 10 years, where Luke is supposed to deploy that capital. So let's just say hypothetically it's 5 years, right? So unlike a money market or unlike a hedge fund or an asset management firm, you only call the capital when you actually deploy it. So you're obligated to that. Now, there's a problem because, right, sometimes these rich people might default and not actually fork the money out. It does happen time to time, but this is a very reputation focused industry. It's really bad if you default on a PE deal or a VC as an LP. So it's not common enough to be regulated, but contractually, all these people are obligated, right? So, let's say, Luke did a great job. He's killing it. He's managing partner, rising star, but he only has $5 million left. He's going to be very, very picky on how to deploy his last, $5 million, unless what? Unless his holding period is done, right? If he has like 3 months left, oh my God, I still haven't figured out what to deploy. He might just deploy that 5 million. Now depending on the contract, he might not be obligated to deploy all that 100 million and say, hey guys, I couldn't find 95 million, and return the 5 million on a prorated basis, like equally based on the percentage that they committed. They can return it back, but he might also be kind of pressured to use all that capital. So for Logan, if you knew this information ahead of time and you were talking to 10 different VCs, you would be smart enough to understand, like, man, my chances of working with Luke are not as good, right? Let's say with Ahmad's, VC, which just raised a new round of $200 million and hasn't invested in a single company, right? Who would you rather go to? Luke.
Take that 200 million, please.
Take that 200, right? You're like, hey. So that's kind of what you need to think of sometimes in terms of dry powder. So I'll show you guys how to look at data in terms of dry powder, looking at companies and which companies have dry powder. So you can strategically try to figure out which ones have the firepower to get you to that next level. So you could strategically think about this in a very calculated way in terms of how you set up your meetings and which VCs and PE firms that you partnered up with. Does that make sense? Pretty fascinating, right?
So they just keep it in the bank account until they find an investment, VCs? I didn't get it.
It's just, okay, so basically, Puya, let's say you raised capital, right? And you raised capital from Persia, Ahmad, Enrique, right? And they all put down, let's say, Vince too. So we can use rounder numbers. 4 people, 25 million each, right? for $100 million fund. They don't pay you anything. Like nothing happens, right? But they all did 25% each. And all of a sudden you want to invest in Logan's company, right? And then Logan's company, you're ready to put down $5 million. You do what you call capital by saying, hey, out of that 100 million that you guys committed to, 5 million of it is going to go to Logan right now. And then then you're going to ask for 1.25 million each from Persia, Ahmad, Enrique, and Vince, because they're the same percentage. So that $95 million still, like, they're holding it. The LPs constantly hold it until you call each time. And you can keep doing that until that holding period or commitment period, whether it's 5 years, 7 years, or 3 years, depending on that period. One thing to note that it is typical for if a fund is doing really, really well, they'll share monthly updates about how well their startups are doing or their acquisitions are doing. They'll start raising capital halfway through or a bit more when the funds are deployed. So let's say fund 1 deployed about 50 million in like year 2 or year 3. They'll start raising for the next fund to get that going. So that's how these companies keep making money. So what ends up happening too is that sometimes you get a fire sale in a weird way, because let's say fund 1 was raised like in 1985, let's just say, right? And then they invested in 30 companies, right? And then like some of the LPs are like dead, they're not even around, right? And then they invest in 30 companies, and there's like one company just left there for like 15, 30, now like 35 years, right? And those just go like, hey, like, let's just close the fund and like liquidate that one company. Like that happens time to time, where it's like the LPs, they've been stuck with this one company for so many years, and it's just like meddling. It's not going up or down. It's just meddling. Just want to get rid of it, call it a day. So everyone gets their money back and then they move on. That does happen time to time. Any questions? I think someone chatted something. Oh, okay. So let's go back here. Okay. So what are some examples of where VCs raise money from? We covered that. What is a capital call? How does this process work with the LPs? We covered that. How do VCs make money?
Management fees.
Lion, how does that work?
Basically, they are given a percentage for depending on the size of the fund. Usually, if it's a smaller fund, it's a a higher percentage, like around 2%, I think.
Is everyone familiar with the 220 rule in hedge fund land? And have you guys heard of the 220?
No.
So as I was saying, it's like a management fee, like just like a fee of maintaining that fund. And then the managing partner will make 20% after the LPs make back their money. So the LPs just break even and then they split 20%. Now there's other like weird stuff like catch up and step up and all that stuff. We could talk about it a little bit more as we talk about like term sheets tomorrow. But understand it's generally a 220 for hedge funds, PE funds, VC funds, very, very common. Now, as I was saying, depending on the size of the fund, depending on the reputation of the PE or VC firms, they might have variances in the fund. Like I remember like Renaissance Technology, like during their heyday, it was like 5% management fee. And then like 40, it was like 540 or something like that. It was like ridiculous because everyone wanted to be part of that fund. That's the carry, basically the percentage that they get. Commitment period, right? What is commitment period? We just talked about that. The time window, right, where you can call the capital to deploy to invest in companies, right? Commitment period. What are walking dead VCs? What does this sound like to you guys? Yeah, like.
It's VCs that aren't that don't have the dry powder, so they don't have the funds to make it, even though they go around and talk about deals, they don't have the capital to commit.
Yeah, it's the same thing with like startup entrepreneurs, right? Who like never get their startup up. How many of you guys have like a friend that's been working on the same startup for like 5 years? Yeah. It's just like, have they launched or how are they doing?
It's a thing.
Yeah.
That's about it.
Yeah. Imagine the conversation like with a Walking Dead VC and a Walking Dead founder, not knowing like that they're both like, you know, the other person's on a dead end course, right? That's, I could just like kind of picture that. It would be pretty funny. It's like who's bluffing who? But yeah, it's the same concept. Like there are VCs that begin to get a reputation amongst founders, and if you start doing really well, you know, there's founders, right, and there's entrepreneurs, but whether it's the PE world or the VC world, there's founders that are just really good at their job, right? They're just. You guys ever watch Jiro Dreaming of Sushi? Jiro Dreams of Sushi. Yeah, Logan, tell me about that. Tell the class about that.
10 out of 10 documentary if you haven't gotten the chance to watch it. It's about a Japanese gentleman who has just a unrivaled passion for, I guess, the culinary arts, specifically sushi, and he spent, what was it, 60 years of his life, and he's still working on it. I think he's still alive, and he's renowned as like one of the best on the planet just because his attention to detail is premier. It is prime.
And he talks about his life is just dedicated to perfecting sushi, and he's not there yet. And he talks about like that's the joy of life, and it should be like everyone should master craft for their whole life, right? So if you ever get to that level of seriousness, I'm sure there's like nothing that we can't do. But the point is, there's people in these circles, whether it's the PE space or the VC space, that are just really good at what they do. They've been in the game for a really long time. So they'll start telling you, right? Like I've been told certain times after I talk to, you know, certain investors saying like, hey, you know, does this person invest or is he all talk? Right. That's pretty, you know, that there, you know, there is a kind of like a blacklist amongst entrepreneurs that will kind of give you these hints. Or they will tell you certain tendencies of certain investors and stuff like that. So yeah, be careful of those types. Did someone oh, Logan, is that the link to the movie?
No, it was a link to the Spider-Man meme, and it was
Oh, okay,
it just
okay.
said a meeting between zombie VCs and zombie founders.
Oh, you found one?
Yeah, it's just where they're pointing at each other. They're like, you, like, it's the same thing.
Gotta watch it. Okay. Key man risk. Why is this important? So this is so this is really important even for VCs or PE firms. Sometimes certain investors build a really strong reputation for really being good at their craft. So during the Me Too movement, there were a couple of Silicon Valley investors that got removed from their or were on the verge of getting removed. So one of them was like Chris Sacca, that was lowercase capital. I think he invested in Uber. And then another one was 500 Startups, Dave McClure. And it kind of sucked because I knew Dave, and he was 500 Startups has been an investor in 3 of my ventures actually. There's this big scandal, and then he stepped down, and the LPs, because there was a key man clause, were able to take back their money. So 500 Startups literally almost went bankrupt overnight because of that certain provisions related to key man clause. So even if there's a controversy pertaining to a fund, it might be benign. The fear that others might pull out might affect your investment as well. Why is that detrimental? Well, because oftentimes when VCs and PE firms, particularly VC firms, invest in a startup, they need the dry powder to keep investing, oftentimes in the same company, because they start building a relationship with that startup. So they'll put money down seed round, Series A, Series B. And if that company is like a lead investor and they start pulling out, and then others start to see that, then if you invested in that startup in the earlier phase before that issue occurred, then your investment runs the risk, right, of going belly up because the capital source could potentially dry out. Does that make sense? Yeah, so you as a founder too, you actually have that risk as well, potentially. It's a domino effect in the ecosystem. Okay, so these are just kind of some highlights. Make sure you go through this. Does anyone know what this is? What do you call these companies? Come on,
Oh, that's venture banks.
venture banks. Any other guesses?
Blue chip companies.
Huh?
Blue chip companies.
Okay, I could see that. Blue chip companies. What else?
thought you were gonna say like star businesses or not necessarily cash cows, but
So like let's just kind of think about this. Like what the frick is Comcast doing? Comcast Ventures, like what the heck? What do you think they're trying to, does this even make sense? Time Warner Investments? GE? Are they still even around? Why do companies do this? Bloomberg Beta? Like the heck? Bloomberg?
do they do this mainly from like an R&D standpoint where they have a company they want to acquire or something like that, like specifically GE, Intel, maybe Google? I mean, Google's egregious with that, but they see a company they like, they're like, we'll buy it. Just give them money. We'll figure it out later.
Logan Smart. Yes. Yes. Basically, that's what it is. Well, that's the genesis of it. We'll get to that in just a second. So everyone bookmark that thought for a moment. So this is called corporate venture capital, right? Why is corporate venture capital important? Well, back in the day, back in the 90s and 80s, people would hire all these PhDs, 200, 300, 400, 500K, whatever that amount was, to do R&D, right? They'll just sit there, tinker with their idea, try to figure out, how to solve the world, etc. Over time, they realize, man, like this is costing us an arm and a leg. Why don't we just start buying startups? You have these dropouts that can code, they're hungry, you give them, $10 million, right, with a proven concept. It's so much cheaper than having, 20 PhDs on payroll, just tinkering with the idea that could be hit or miss, right? So what happened over time, corporate venture capital became like this booming industry, and it's still continuously growing. And you can see this even at schools, right? A lot of schools now have their incubators, their accelerators. It's prevalent throughout all sorts of industries, right? So this is basically corporate venture capital, and it's probably not going to change. And what's really exciting about this is that oftentimes these firms will, if you're a founder or an entrepreneur that sold their company for a ton of money, you could actually apply to these VCs within a corporation and just become an EIR. Do you guys know what an EIR is? Okay, an EIR is called an entrepreneur in residence. And oftentimes in VCs and sometimes now in PE land, they'll let you just like sit there and just figure out your next idea. And that's all you do. You just help other startups, mentor them as an EIR, especially with your proven track record and your knowledge with a certain industry expertise. And you get to join these companies, sometimes these schools, to just tinker with an idea until your next idea comes about. So it's very, very prestigious to become an EIR and then jump into your next venture. It's almost like you get paid to just chill out for a year or two. It's like a gap year being an entrepreneur. Now, there's problems with sometimes, having meetings with these corporate venture capital firms or funds. Why is that? Can someone take some guesses? Can we take some guesses here? Why would it be a problem? Like, going back to Logan, he was doing, let's say, ed tech. Is there an ed tech company here? Okay, let's say Lai is doing a fintech venture, and then all of a sudden, Citi Ventures hits them up. Hey, we love your idea. You know, your banking app looks awesome. Lai's like, oh my God, this is great. They're gonna fund me. What are the potential red flags here?
Well, they may be desperate for a reason. If they're reaching out to me.
Well, that could be true, but I think there's a bigger problem. What would be the problem here? Potentially.
Have some pride, my man. Come on, you're worth it.
No. They didn't give him the offer, right? It's not desperation, Logan. I appreciate the comment, but what Citibank or Citi Ventures is part of Citibank, right? Lai has this amazing banking app, right? He doesn't have that many customers. Let's say he's doing about $1 million a year, right? And then Citi Ventures, they tested the app, they demoed it, and everything like that. What's at stake potentially?
They're gonna just want to buy the app outright.
No, what's worse is that they might just steal the app. They can just copy his idea and build it himself. Just change the buttons a little bit and say like, "Oh my God, this is like, thank you, Lai." So these CVC firms, right, corporate venture capital firms, they have a reputation for stealing ideas. So next time, you're doing a, fintech business, American Express Ventures hits you up, you might want to double think that. Just be very, very, very cautious. And even for us, right? When one of my startups was growing really, really big, that was my job, looking at M&A deals. But the side benefit of looking at M&A deals is that it gives you ideas on, what moves you can copy, what's going on in the market, etc. Everything's always on NDA, but you're exposing yourself, right, to a potential competitor. If they outright buy you, it's great. But then what if someone in the meeting says, wait, isn't it just cheaper to buy or build Lai's product than buy them because Lai wants 7 million and we think it's only worth 3 million? Why don't we just build it for 2 million, offshore it, and then we'll just ignore him, right? So that's kind of a very, very tricky situation that you can put yourself in. So these are just some of the things that you need to be very, very careful of. Now, on the flip side, if Lai's able to build a really good relationship and Citi Ventures like, man, like we think this is great. You have this stronghold, let's say in the, I think you're Vietnamese, am I right? Yeah, this is very popular in the Vietnamese, shadow banking market, or suppose, in the market that could have been in the shadow banking industry, and he's killing it, right? And Citibank's like, we don't have any expertise there. Like, why don't we just give Lai like $3 million and see what he does? And he grows it, right, to maybe a $30 million company. And like, man, like before he even gets bigger and cannibalizes our venture or our Citibank business in Vietnam, let's just buy him out. So it could be a double-edged sword. It could be a strategic buyout, which Citibank would probably pay a multiple of that because now he has investments and he goes like, all right, I'm going to flip it to, I'm going to flip it to like Bank of America. I'm going to purposely get them enticed so I can flip it to a competitor and get them a premium. Now he can start a bidding war off of that, and he has the market in Vietnam as hostage for Citigroup, right? So he could actually use it against Citigroup, right, and make it a little bit more exciting, right, for him to escalate that exit price, and to Citigroup, Bank of America, and then if you get something like JP Morgan Chase into this race, like 30 million, 50 million, 70 million, like it's nothing to them. That's why sometimes with strategic buyouts, you see really, really absurd multiples because it becomes a situation. It's not really the valuation of the competitor or valuation of the company. It's just they don't want to lose out to the competitor and lose market share. So has anyone heard buyer's curse in M&A? It's basically when buyers pay too much and then they never win really because they just overpaid. and then the value that they brought the company that got bought out it never justifies, because it's just they just bought it off of a bidding war. So that's, you know, that's what happens. So yeah, these are CVC, corporate venture capital firms. Who do the executives eventually report to? I mean, the parent company, right? So you got to watch out, watch your back. Why are they willing to pay higher premiums? You know, I just mentioned for you know, various reasons, right? A lot of these initiatives are basically for strategic reasons, whether they want to copy your idea or whether they want to buy you or prevent you, right, from gaining market share. And yeah, you just need to be careful, because if you catch their radar, it's a really, really good thing. But at the same time, you know, you have to be very, very careful on how you share that information. Okay, cultivation capital discussion. So let's just talk about this. So did everyone get a chance to watch the video for cultivation capital? Some of you guys? Okay. If you haven't, please watch it. Normally for these videos, you just watch it at like 1.5x speed. You know, you can get through it pretty quickly. Okay, who are all these different investors? What are the 3 F's again?
Family, friends, and fools.
Family, friends, and fools. Okay. Yep. Angels, you got the accelerators, incubators, seed funds, venture debt, banks, you know. So the earlier you are, the riskier it is. The later you are, there's more cash flow for the company. The holding period is extended the earlier you are, right? So there's just different phases. Most startups fail in the VC space. So sorry about the blurriness. Failure to raise the following round, 80%, seed to Series A. Failure to exit, 97%. Series A, 88%. Series B, 84, 80%. So even at like Series E, F, and G, you're still more likely to fail than to succeed. The tides can shift rapidly in the startup space, and it's very, very hard to adjust, because if the tide shifts against you, you can't get any money from the bank, right? You can't get a loan because you're not profitable, and you don't have excess cash to readjust. So since you're so dependent on VC money, you know, the dynamism of those markets could really reverse the course of your company. So you know, that's just one thing to be very careful of. Let's talk about the typical VC process, right? This is the exact same thing as the typical PE process. So how many pitch decks do you think a VC normally goes through each week or each month?
I guess 500 for the month.
Yeah, 500, you know, probably more, thousands. So Paul from Cultivation Capital, he says he looks through at least 200 pitch books a week. So he's close to, you know, 1,000 or so. And Cultivation Capital isn't even like the biggest one. They're pretty big now in the Midwest, 300 million assets under management, which is pretty solid size. But they're not like Sequoia big or something like that, right? So they're looking at thousands and thousands. So as they're looking through the deck, they literally spend oftentimes fewer than 10 seconds. So your deck has to be really, really good. And if they like you, they'll do initial, you know, follow-up call. Same thing with our PE fund. I mean, we're technically a search fund, but we operate at the level of a PE fund in terms of deal flow. So we assess at least 1,000 companies per week, not even like per month, per week. And then out of those 1,000, we probably have about 10 meetings a week. And then about 20 potential companies with inquiries, like emails going back and forth. And then out of those 10, we only evaluate maybe 2 that we take seriously. So to even get to this due diligence stage where we put in an offer, it's about 0.6%. We actually did the numbers last week. So out of the companies that we actually have, let me see here, that we actually qualify and we send out emails to, it's only like 0.6% that we actually go through some kind of IOI stage. So same thing in the startup land. I mean, less than 1% of these companies get funded. And then that leads to initially like a basic analysis, like, hey, you know, what's your vision, et cetera. Oftentimes you'll talk to a younger person, associate or VP. And then when it gets serious, you'll probably talk to a managing partner, two or more, you know, one or two or more. And then they'll go through some due diligence, pass or no pass, and you get a term sheet. And then you get to decide. It's not too bad. These meetings are pretty benign compared to maybe like a PE, I guess, like meeting, especially in the earlier stages like seed and Series A. A lot of it's like systemized because the ecosystem now in Silicon Valley or just globally in general is very, very robust. So there's no reason to, you know, panic or be nervous or anything like that. Some of the leading incubators like Y Combinator, 500 Startups, Techstars, it's less than a 1% acceptance rate. So very, very competitive to get in. But this is a very typical VC process. So this is just kind of like how much time, you know, VCs might spend. You know, there's qualifiers, right? They look at industries and technology. So when you're hitting up a VC or even an angel investor, look at the investments that they have made. And we're going to talk about resources in a little bit to make sure that, you know, if you are doing a fintech business, they are investing in fintech businesses, right? It doesn't make sense for you to like constantly hit up, like, you know, for example, a company that only invests in like the medical industry. And you're like, oh, I have the greatest fintech app. Like, dude, like, are you stupid? And then you might just like even build a bad reputation in the VC space for just being so stupid. So just be very careful of that. You know, you want to be very conscious. Same thing with angel investors, right? You could even find a company that you like or admire in that same space and look through something like Crunchbase and look for the funding that they received, because oftentimes investors will just want like a repeat success. And they're like, oh my God, another med tech company that is similar to that previous exit that we had. And it's more likely to pass through with the LPs because they were very excited about the previous exit. So you want to use that as a strategy as well. They'll look at different stages. Is it the right stage? Some VC firms, you know, care about, you know, at the very early stage, somewhere at the later stage, check size, round size, how much you have left. Normally, if a VC doesn't know you, or even an LP doesn't know you, or any investor that doesn't know you, they'll purposely almost ignore your emails the first couple of times, just to see how good you are and how resilient you are and how you deal with rejection. Because that's a really good barometer to see how you're going to deal with co-founders, potential customers and sales, how you raise capital from other investors. So they'll test you on purpose. So be aware of that. And I think a lot of entrepreneurs get discouraged way too early and way too quickly and rely on intros. You want to have a good system of generating inbound and outbound leads for potential investors that are, you know, both from your warm market as well as your cold market. Oftentimes what VCs find very important are very different from founders. So founders care about speed, obviously, because they're always running out of money, and deal terms, right? They care about personal relationship, investment sector. VCs really care about like prestige and being like brand. So they care about like the entrepreneur's brand a lot. Like what school did they go to? You know, what company did they exit from, or what company did they build, etc. Are they like an expert in their field? They care about that a lot, unfortunately. And I think it's really stupid because they miss out on a lot of great opportunities. But that's what they care about. They care about like the experience a lot. They do prefer founders that have, you know, some wins and some losses. Even if it's like a failure, they they care about founders who've been around the startup space at least once or twice. Interestingly enough, in the VC space, if you failed at your startup before, it's deemed as a plus, opposed to someone who's never tried. So it's unfortunate because I've seen so many of my startup friends never try again after they fail their first startup. But that's what's great about American capitalism, and just the VC space in general. You're forgiven, and they give you a lot of points just for that experience alone. And your network, and then I guess like all these other things are pretty mutual. So here's another breakdown. You can see like the differences here on what's important and what's not as important, and how it's different for each groups. Fundraising amount tends to shift, right? VC firms are at the later stage, accelerators, friends, full and family, seed stage, general breakdown. This is in your book. And this is, very similar to this slide over here. Yeah, can we watch a really quick video? 3 minutes? Okay, let's do this. I think we have time for a video. So I want you guys to know that, like, so one of the things that I've always been really good at is, what do you call it? Like, my bite backs have been like really good. Like during an investor meeting, like I know to like call them out, or like the seller meeting. I was telling Elena the other day, I'm like, dude, you don't know me. Like, I have no problem saying F you in the middle of a meeting. Like, that's been my style. And that's worked really, really well. Especially when it's unexpected, right? So I want to just share with you this video about, like, more often than not, it's really just about swag. You're coming with this like novel idea. No one really knows the valuation, right? So Enrique's valuation of the sim had $38 million and mine had like $10 million. Who's to say what's wrong? Like, Enrique's numbers all backed into that, right? And then same with Lai. Like, he looked at, foreign entities, and he was able to find multiples to justify the valuation, right? But I like to say, well, the valuation is what I want to pay. At the end of the day, there's no such thing as financials, right? So I want you guys to kind of reference this, because there are certain people that are just really, really good fundraisers. And I think the ones that are really, really good, the common denominator is that, like, they're able to go from hot and cold really easily. Like, I like to say, like, they're able to punch someone in the nose and then offer them a beer. That type of mindset could go really, really well in terms of, like, in these kind of like negotiations where it's like a jump ball. It could go in any direction, because no one really knows the true valuation of a tech company. But this is if you guys haven't had a chance, watch this sitcom. It's pretty good. Silicon Valley.
But you shitting all over them counteracted their shitting all over us. Only feminists. See, everybody wants us, but by shitting all over us, we try and bring our price down. But you shitting all over them counteracted their shitting all over us. You nagged a nag. Richard, this could be good. Where do we have next? Ross Sloan Capital. Should I keep doing it? Should I keep nagging? No, I'll handle this. They want to negotiate using hostility and rudeness. Well, they picked the wrong guy.
Well, you see, our main concern is how you're going to achieve escape velocity on your growth rate. Get critical mass. I'm sorry, what's funny?
It's just that painting behind you. It is awful. Looks like Harlequin Kama Sutra done poorly. So I agree. Bad culture fit. I think we just all move on.
Look, I didn't say anything about a culture fit.
No, I did. Okay, well, thank you for meeting with us. We have a bunch of these things to go to, hopefully with more tasteful artwork. And your logo looks like a sideways vagina. I find that to be racist, don't you? Okay, here's my concern. Here's my concern. Who the hell picked out that shirt for you? What? Oh, I see. The pants. So I guess it's a whole thing. My wife picked these out. Then you married poorly. You care about Pied Piper?
Do I care about Pied Piper? Well, of course.
Because if you do, I'm not seeing it. In fact, what I think I'm seeing is the human equivalent of a flaccid penis.
Flaccid. It's actually pronounced flaccid. Not a lot of people know that. Well, we are definitely interested, but I think we need to. I'm sorry. Is something wrong?
No, this is all wrong. I am sensing a general lack of vision. Your muffins smell like shit. So do your ideas. One of you is the least attractive person I've ever seen. I'm not going to say who. Should we leave or should you?
We just got offered 8 at 40. We're 5 for 5, gentlemen. And Galveston Capital Fund and Yountville Ventures called. They want to move their meetings up before everyone else. Hey, let me try. I want to be rude at this next one.
Go for it.
So with some proper funding, we should be able to get a functioning beta in time for CES. And if you don't fund us, you're a fucking slut. Oh, what's that smell? Is it a fart? Are you a farter? Now, can I have a pastry, or are you guys gonna eat them all? 'Cause you're fat.
It's not your fault, Richard. This is just something that can't be taught. So leave the next one to me. I can feel a big one coming on.
What are you gonna do?
I'm not sure yet, but give me room. There's something inside of me that has to come out. Who am I to stop it?
His balls. He put his balls on the table? Right on the table. On purpose? I don't see how it could be by accident.
Richard, I just got an email from the guys at Midland Oak. Apparently there is a line, and I crossed it. The line between 12 and $15 million. Ba-bam! Midland Oak's offer just came in. Gentlemen, we are valued at 75 million, fully diluted.
Are you shitting me?
Take a look at these term sheets. There is a linear correlation between how intolerable I was and the height of valuation.
Hey guys,
It's pretty good, right?
this is Lori Breen, the
So-
new managing.
As far
Wait,
fetched.
is that Monica? She finally opened it.
Oh, yeah, that's odd. Says here that she started using it yesterday.
Wait, so she lied? Why would she lie about using the beta?
You know, why would Dinesh lie about having friends? Why would Tara lie to me about?
Okay, sorry about that, guys. So as you saw from that video, it is not that far-fetched. Like there are people that just have the raw confidence that is able to do that. But if you're really into negotiations, like you can notice that even though his insults were a little bit something that you can't do in real life, he was using misdirection. He was like talking over the investors. He was also reframing. He was also, what else was he doing? He was also changing the subject, right? So there's all these things that he was doing that he was doing very, very well. So really good negotiators are able to use those to get the conversation more into a direction that, puts them in a favorable situation. So it's not, it's definitely not too far-fetched. Let's take a 5-minute break really quickly, and then we'll reconvene and wrap things up. Home stretch. It'll be the home stretch. Yep. Okay, guys, home stretch. Here we go. And then you guys could go out and party. Okay, so we'll talk about resources and tools. So if Y Combinator has an incredible amount of resources that you can look into, and what I like about Y Combinator is that like they have their own metric in terms of like valuating companies and stuff like that, and they've had such a great track record of doing really, really well. So if you want to learn more about startups and how like valuations are assessed, particularly in tech, and whether you guys decide to do tech or all tech or not tech, I mean, at the end of the day, every company is going to be a software enabled company. So do check this out when you have a chance. It's called Startup School. You can actually get a certificate and meet some of these guys actually in person when COVID's over. So they actually have a really good program that they run. The other thing is, let me see here. A lot of this stuff you could actually check through the Accelerator database. So if you look over here, what this does is that it gives you all the companies that some of these investors have invested in. So if you click on, let's say like Y Combinator, you can see the number of exits, the average cut that they take for each investment, every single batch that they ever invested in, right? And then what's really important is that like, well, you can also find the current valuation of a lot of these startups, but you can also see basically like who invested in these companies if you kind of dig in and do your research, so that when you're raising capital, if you have like a very similar concept or an ed tech company, you can actually locate these people to help you get access to the interest that you need. Furthermore, another great strategy is that just asking for some of these people to become your mentor. So whether you're starting an e-commerce business, whether you're starting like a fancy ed tech business, just being able to do your own research and using these resources to get a sense of what you should do with your company could be really, really helpful. So you could see, you could go by which accelerates the best when you're applying, based off of, I don't know what this is by, but yeah, this is number of companies invested, right? Maybe that's one metrics you want to focus on. Maybe it's like the number of exits and total value, right? So, Y Combinator, by far, the biggest, and then Techstars, wow, they caught up a lot. What did they get like recently? They were at like 1 billion and they jumped to 6. Jesus, very interesting. Dream Adventures, Facebook Fund, right? Where we talked about, what else? Amplify in LA, they're doing pretty well. So, there's a lot of really good ones that you can look. A lot of them are even virtual, right? So if you're looking to get some startup funding and mentorship and you don't want to fly out, there are some good ones for you guys. Are you guys familiar with Crunchbase? Crunchbase? Familiar or no? So yeah, Crunchbase is like one of my old startups. So you'll find like a ton of stuff that's available where you can find all this information. And AngelList is a great site to recruit, apply for jobs, as well as invest in funds via a syndicate. So AngelList is like a nice little community you can do. One thing I want to cover is PitchBook. I'm not sure if Chapman has resources to this. I hope they do, because this is a great site if you're looking at PE firms to look at what kind of dry powder that some of these companies have. So someone give me a PE firm that that you guys want to look up. Any names?
Blackstone comes to mind.
Okay, let's look up Blackstone and see how much. What is this going like? Why do I have to sign into all this junk? Okay, let's go to Blackstone and see what's up there. Dun, 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 dun. Okay, so they're traded in the New York Stock Exchange. Let's see who are their LPs. Let's see the funds here. It's probably a ton. See a more recent one. So let's see this one. 311.14. So no dry powder. So they deployed all the capital. Well, at least maybe they couldn't extract all the data, but at least that's what it's showing. The fund is fully invested. So that one's too far back. So let's see a more recent one. 2020. So let's see right here. So see, look at that. What does this mean, guys? It's Christmas, right? Yeah, so if you're trying to sell, like, this is what you're looking for. Same thing with VCs. You want to check the dry powder. I mean, heck, if they say no, you could also technically hit up their LPs if they're really rich angel investors, right? So you could, the reverse could actually happen as well. So this is not clean. But there are certain sites that would list out all the investors in their cap table. So I don't know. Let me look up. Let's look up a company. What's a company that we should look up? Any startups that you guys want to look up? What's a startup that's doing really well that's not public yet? I don't know. Headspace, meditation app. Okay. So you could see here, you could yeah, you could see all their investors here, right? Info financials. So these are all the investors that they have. Let's look at 10x Capital. And then you should also be able to find a list of their LPs, I believe. Lead partners on deals, right? Investments in M&A, exits. Yep, co-investors. It's a good one. Maybe not. Maybe you can't see the LPs. But these are also, really good data points, right? Where you can use that network to get investors that you want to get access to. So there's a lot of stuff that I think a lot of people don't research enough when it comes to investors. And those are, some of the tools that you can leverage. We're just gonna talk about like PE economics really quickly. Has everyone had a chance to talk about or has everyone had a chance to go over the PE multiples doc? By any chance, that was on the modules? Okay, so one thing that we forgot to talk about was the multiple expansion effect from a company becoming big or small to big. Does anyone know what it is? Multiple expansion? So basically, as a company gets bigger, right? So remember when Puya and what was it? Lai, their team with Enrique, they looked up valuations of companies, and the multiples were really, really high, right? Like sometimes like 60x, 30, 40x, and stuff like that. Well, these are the sizes of companies in the small and medium-sized market, and you could see, right, the revenue is a lot smaller, right? And then you can look at the EBITDA numbers, and then the ARR. ARR means annualized recurring revenue. So this applies to SaaS and subscriptions. And you could see the enterprise value to EBITDA multiples. Maybe if you take the medium, it'd probably be like 7 or 8. It's nowhere near 30x. So what happens is that as a company gets significantly bigger, people are willing to pay a premium, Why is that? Why do you guys think that is? Why is someone willing to pay for, you know, 100x EBITDA for a $50 billion company versus maybe like a 9x EBITDA for a $50 million company? Why is that?
Because they could see the potential of where the company's going, and they're willing.
Time, Logan.
Oh, sorry about that. They're willing to pay that premium because they can see where the direction of the company's going. They're expecting more growth, I would imagine. So they're also probably expecting a fight across a bunch of whole other firms and whatnot. So I think
it wouldn't be more growth though, because if a company is 50 billion, right, it's already a lot more mature than the $50 million company. Lai, you want to take a shot at it? I think you're about to speak. No.
I wanted to say something.
Okay, Puya, go.
Because as the companies grow, the risk of default decrease significantly.
Yeah, exactly. A $50 million company is probably, you know, there's a good chance it might go bankrupt, right? While as a $50 billion company is much more stable. You know, if it's like 50 billion might be too expensive, but like I remember there was an investor talking about Tesla, that even though the multiple was so high and there was a chance that it could go bankrupt, the technology was so good, and if it gets past $1 billion, if it's decreasing, it can still get bought out, right? So that's kind of like the scenario. Like a $50 million company, can it get bought out? Maybe 100 million is much more stable. So what happens is that these multiples normally happen in brackets. So this might not be as relevant in today's market. These valuations are a little bit more inflated, but you know, up until a couple of years ago, it was like a 4x multiple, less than 3 million in EBITDA, 5x multiple, between 3 to 6 million in EBITDA, and 6x. This is not for a tech company. This is just for a professional services type of company. So as you can see, like as the EBITDA increases based on your assumptions here, you apply a different multiplier, right? That is correlated with the EBITDA. So if it's 7.63, the EBITDA would be something like, yeah, 6x or 7x, but you could change this to 6, right? So the valuation would change dramatically. So what a lot of investors, when they're trying to buy, they try to arbitrage that strategy and try to hit like the edge of a certain bracket so they can maximize that run off that exit. So what kind of buyers would pay the most in a, you know, acquisition situation?
I think the buyers that already are in a situation that if they acquire a company, they can benefit from the merge and like create more value than like when the companies like merge, they can create more value. So basically they merge the technology, the resources, and they will create higher value than just the book value, you know, just the book value of the revenue and income.
Yeah, strategic buyers generally pay the most premium. They can create synergies, they can cut costs really effectively because everything is already set up. And then other companies that pay more would just be generally bigger companies will pay more because they have more resources. And then, you know, PE firms could pay more, but generally more like than individuals can, or like smaller investment groups. What's recently happened is that there's been a flurry of M&A activity. So we're hitting an all-time record. This is actually a couple months ago, or like a month and a half ago, May 2nd, or 2 months ago now. Yeah. It's been a whopping 10%. North America, 32% higher than any other time during the same time period. So it's a great time to buy a company. Also a good time to sell a company, I think. So I do think it is a seller's market because there's just so many capital right now floating around. Yeah, these are just some of the things that are occurring in the current market. So I'll post this. If you guys are interested, you could read that. But yeah, today's class is over. I'll stick around for any questions. Congratulations, guys. we made it through another Friday. But yeah, I'll stick around for any questions.
Yeah, I have question.
Yeah.
For the midterm exam, is it gonna be like the first assignment, like case questions or like calculations, like today assignment?
No, it's usually like a true or false, conceptual questions. There's not going to be a financial model. It'll be concepts from financial models in kind of like a question format, but not an actual model that you do.
Okay, thank you.
Thank you very much, Professor. See you tomorrow morning.
Thank you.
Guys.
Thank you, Professor.
Yep.
Sorry, I had. Oh no, please go for it.
Okay. So is there a linear relationship between the size of the